to our guest today, Pramod Gubbi of Marcellus Investment Managers. He joins in on the show after a long time. Is about the kind of shrugging off that the Indian markets are doing around most things which would typically be considered high beta. New listings are getting subscribed well, listing well. A Hindenburg note which really brought a lot of volatility in 2023 has been shrugged off quite vehemently by the markets yesterday. And typically, Pramod, when global markets used to move 5%, Indian markets used to move 7-8% in the past, right? We've now suddenly become a low beta market. So what's happening? Is it domestic flows or is it something else? Good morning and great to have you.
Good morning. Always a pleasure. Thanks for having me, Neeraj. Yeah, I mean, it's that stage of the market cycle, right, where people throw caution to the wind. There's no concept of risk really, and particularly reflective of the heavily retail-oriented flow nature of the market. But there's hardly any regard for earnings. I mean, I can understand some of these macro events have been sort of misleading, but at least the earnings season should have meant something in terms of having some semblance of reflection of stock prices to earnings. That hasn't been the case either. But yeah, I mean, and it's not the case in India itself, right? I mean, we've had geopolitics situation play out globally for the last couple of years, and markets across the world have only gone up. We've had the scare last Monday in Japan, and yet we seem to have forgotten all about it. And not just in India, across the world as well. Even the S&P has made a comeback. So it's a very peculiar phase of the market where absolutely nothing bothers. In India, at least, we can understand because this is largely retail-driven. Flows beget flows, which in turn push stock prices, which attract further flows. So we're in that self-fulfilling stage of the market. We've seen this in the past. This is not the first time. We know how that turns. It doesn't take much for it to turn the other way. But the challenge is in terms of knowing what will drive that turn. We've had a lot of events, like you pointed. Nothing seems to matter. But at some stage, I guess this will end.
Yeah, but Pramod, just wondering if I mean, because we were doing the statistics, right? It's not just in the Indian market. I mean, we're seeing this play out global market too, right? I was seeing this statistic about how Amazon's AWS revenue of the last 12 months was higher than the revenue of maybe another 400, 500 companies. Or if you look at what Apple has done, right? P ratio has moved from 10 to 30. It's not that the growth in business has been that great, that strong. So valuations across markets, etc., have all moved up. What could bring this down? Because we are now staring at a Fed rate cut cycle. The past 4 years have shown that any such instances turned out to be net positive for equity markets by and large.
Yeah, I mean, that's the million-dollar question. I don't think all we know is corrections are a feature of the stock market, but very rarely do we know what drives that correction. And like they say, the biggest risks in the market are the ones that we can't foresee. So like I said, geopolitics has been a concern. I mean, there are wars happening across the world, yet the markets don't seem to be cognizant of that. We've had a little bit of a scare in terms of a market crash last week. We've taken that into the stride. We've had a fairly lackluster earnings season, mind you, so even that doesn't seem to bother the market. Financial crisis, possibly. I think that risks are rising in the US, something like commercial reality, sort of resulting in a bank or two going belly up could be the trigger. More often than not, that has been the trigger because there's a contagion effect there. But we don't know. The risks on commercial real estate have been around for a while now. But yeah, I mean, it is a bit of a futile exercise to figure out what will drive. Better to focus on valuations to bottom up, make sense of earnings potential of companies, look at where valuations are, and accordingly build portfolios. And today, it's a very hard bargain across the market. I mean, the Nifty is a bit misleading in terms of its price to earnings ratio. The broader market is way more expensive. Median valuations are perhaps at all-time highs, even more than the peak of the 2007 rally. So, I mean, it is important rather than trying to second guess when the market will correct, because markets may sustain this momentum for longer, but better to work bottom up, get yourself earnings comfort, get yourself valuation comfort, and stay invested.
Got it. Okay, Pramod, the nature or the let's say the areas where the market is betting on have changed a bit, right? In that, and they always change, of course, but just that there is a wider universe available. If 2023 belonged to defense and railways, suddenly we're seeing a bit of a flurry for energy as a theme, and energy as a sector that is coming up. Where is it that Marcellus has the highest conviction, let's say, for example, within some of the non-heavyweight sectors? So I know you guys must be constructive in finance and financials, and those stocks have done well. It's, or IT, you might have a different view, but those are heavyweight sectors. What about the non-heavyweight sectors?
Well, I mean, we remain bottom-up investors. Our focus is more on factors. We would position ourselves on quality and growth. So therefore, a high ROC is fairly important. That itself rules out some of the sectors. Growth visibility hasn't been that great. Clearly, pockets of the economy are slowing. There are some green shoots in consumption, particularly rural consumption. But consumption is a sector which also has been derated consistently over the last few years. So you're right in terms of what they call as the regime change in the market. We had a very long period of a unidimensional market over the last decade, say the 2010s. It's only in the last 3 years we've had a broad basing of the economy, the broad basing of the market, where certain sectors like industrials, capital goods, thanks to, say, spending from defense, railways, and all, have come back into the reckoning, both in terms of earnings growth as well as the valuation expansion. That, I guess, is running out of steam at this stage. Maybe some specific sectors with defense spending could sustain in terms of earnings growth. But I reckon you're right. There's been a shift in terms of the market attention. Consumption could be bottoming out. There could be interest coming in as even the government policies move towards boosting employment and hopefully consumption. We've had a reasonable monsoon. Inflation seems to be cooling off, at least the food inflation. So that should mean that rural consumption should pick up. So low ticket FMCG type of sectors could come back into growth. And like I said, valuations have been fairly reasonable. Financials, of course, yes, we all know, particularly the banking system has been struggling to raise deposits. It is a reflection of the state of the economy, the state of the markets we are in. We've had a high inflation, so the central bank has had to keep liquidity tight, but at the same time, a lot of the liquidity is flown into capital markets, which has deprived the banking system of deposits. So therefore, in some ways, the banks could become a hedge, because if we see a correction in the capital markets, maybe some of that money will flow back into deposits. If we see economy cooling off further, we could see the central bank getting more constructive in terms of liquidity easing. That could also help banks. And valuations are perhaps that's the only pocket in terms of large sector which continues to remain attractive. The other pockets, of course, we have some interest in capital goods and industrials where we have earnings visibility. I wouldn't say across the board as a sector, but you'll need to be more specific and bottom up. We do see some opportunities there. But more importantly, I think as we enter a very difficult phase in terms of earnings growth, the presence of comparative advantages becomes a big driver of earnings in a situation where all boats are lifted by the tide. It becomes more broad based. When the going gets tough, those strengths of balance sheet strength, comparative advantages come to the fore, and therefore it becomes great for bottom up investors and
right.
discerning investors to pick up stocks.
Pramod, any thoughts on the ancillary businesses of power. I mean, these are large market caps now in some sense. Suzlon is over 1 lakh crores of market cap. But any thoughts on whether this or power financiers or any of those others? I'm not just talking about the energy producers, but some of the ancillaries, because all of them have moved up the valuation chain.
No, it's very difficult to see. The valuations are suggesting that demand for power will go on till perpetuity. I know power is a crucial sector. It's not like we're a developed country with penetration of power. There is a long growth runway indeed. But today, whether it's for the power producers or the equipment makers for the power sector, valuations are simply not sustainable. In my view, at least, it's very hard to justify without taking very unrealistic expectations in terms of longevity of growth. So it's not a growth sector. At the end of the day, it is utility. Yes, there is under-penetration, but at this stage, we don't see any sort of place that, if you're a momentum investor, it's a different point, but if you want to do fundamental investing with some sense of intrinsic value, it's really hard to find that value.
Pramod, the new kids on the block are getting subscribed very, very strongly. They are listing with good premiums. We've seen that happening with Ola. We've seen that with the two companies today as well, including Unicommerce, and a fairly diverse range of companies coming in as well. It's not just an auto ancillary. It is not just a pharma company. These are differentiated models. What do you think of the newer spate of listings that have happened? Because it's been very varied. Anything that has stood out for you guys at Marcellus?
Not really. I think at this stage of the market cycle, we would rather be prudent in terms of looking for businesses which we understand really well and have gone through cycles. Not to say anything about the new listings, but for exactly these reasons, right? So the sort of demand for these IPOs doesn't allow us to take a more nuanced view. But that's the nature of these rallies. IPOs tend to benefit. But more from a structural perspective for the market structure, I think this is a great deal. The sort of businesses that we are coming into the listed space are becoming a lot more diverse. It's great to be managing funds or be a research analyst in these markets. And also from demand supply perspective, it's great for more and more paper, more and more equities to be available, given the sort of structural increase in financial market participation that we're seeing from Indian investors and Indian households. So we will need more and more businesses. So it is a great deal from that perspective. But it's very hard in these markets, looking at the screen now, these sorts of moments. It is a reflection of the frenzy that you talked about. And we tend to stay away from that.
Pramod, if not newer listings, then mobility, auto, is there something that is looking interesting here? Because that too has got a variety of things coming in, including battery storage, electric mobility, all the new facets coming in. What are your thoughts here?
Yeah, I'm sure there is a structural change in the whole setup, whether it's electrification or autonomous. The automobile industry globally is going through structural changes, which allows for opportunities to come in terms of incumbents usually suffering from innovators' dilemma. You'll see new entrants making a grab for the market share and growing faster than the industry. Having said that, we have been more watchful. We're quite happy to let these initial sort of disruptions play out because we tend to be longer term investors. We would like to see longevity and performance across cycles. That also comes with its attendant risks that we might miss out on very attractive valuations very early on. This is a market that's unlikely to be the case. We will hope for better entry points there. We've been very limited in terms of exposure to auto. We own iShare, which has exposure to high-end motorcycles and trucks through the joint venture with Volvo, where we find there is an opportunity for growth to justify the valuations. We like a lot of other businesses, but valuations have been hard to justify. So we will wait for better entry points across the automobile space.
Okay. Okay, we might, I think Finance Minister is speaking and we'll probably cut across there. But just before we do that, Pramod, financials, because you guys have such a deep research out there, you ran a Kings of Capital portfolio, probably still do. Just trying to understand, we are at the cusp of a Fed rate cut cycle, if you will. Maybe inflation drops in India further and maybe even RBI does something. Independent of that or because of that or otherwise, are financials within a bucket that you like, and would you invest in anything for lending or non-lending financials?
Yeah, I mean, the lending financials is where we find valuation comfort, particularly the banks. And we know the reasons. They've been out of favor because margins have been on the decline. In some pockets, even asset quality deterioration is sort of rearing its head. But given the valuation comfort, and like I said, any sort of cooling off of the economy resulting in loosening of monetary policy, loosening of liquidity could revive deposit growth, which in turn should help the margins. Now, what will drive that? Like you said, it could be the Fed rate cut, cooling off of inflation. And like I said, even a cooling off in the capital markets could release some liquidity into the banking system. So that remains a key area of comfort, at least from a valuation perspective. The non-lending financials have done really well. We've benefited from a lot of exposure either to the insurance place or even the capital marketplace. That's where I would be a little more cautious, given that these look like peak earnings and peak multiples. Any sort of risks on the capital market, you could get a double whammy on the downside. So again, going back to valuations, we would rather prefer the banks which have sort of struggled from a deposit growth, and that's kept valuations attractive. And deposits are cyclical. We know at some stage they'll come back, and we should see the benefits of that coming through.
Okay. Pramod, last question. Do you sense any slowdown in government focus on capex, railways, roads, other things post-budget, or do you reckon that it continues as was announced in the Feb budget?
Very early days yet, given monsoons, these things tend to slow down seasonally, but we'll just go by what the government has put out in terms of numbers, and full credit to the government to have done the balance on the budget through capex growth, at least the budgeted numbers remaining as it is, and yet finding some amount of money to boost employment and therefore consumption. I think the RBI special dividend of sorts helped do that, but I think it's very early days to figure out if there's any slowdown on the capex front.
Okay. Well, Pramod, hopefully the frenzy doesn't end in a whimper. Even if there is a correction, let's hope it's a bit more gradual and calmer. The Indian markets have turned low beta. Let's hope it stays that way. But thank you so much for all the insights today on Talking Point.
Pleasure is all mine. Thank you. Thanks for having me.
Well, the pleasure was ours. The Bank Nifty is the culprit today, by the way, down about 0.5%. HDFC Bank leading the charge. Else, the markets might well have been in fine fettle because IT literally is masking up for all the losses that the Nifty Bank has put out in the session. Thanks so much for tuning in to this edition of the Talking Point. It's a wrap.